So in the last video, we had a look at the difference between day-to-day operational cash flow in your business and investment cash flow where you are planning to grow your business on a long-term basis. And the types of external financing that would be appropriate are different depending on whether you've got short-term operational needs or long-term growth needs. And the first external financing option that we're going to deep dive into today is business loans. We're going to have a look at all of these things, talk about the pros and cons of business loans, when they are appropriate to use, when they aren't appropriate to use, and also how you go about securing them. So currently in the UK, there's about £500 billion lent to UK SMEs. And by the time you've taken out those loans that are for the bigger businesses, round about 70% of what's left are actually small value loans of under about £15,000, and they are given to very small micro businesses for cash flow purposes. So when you're in this sweet spot of being a business of about 1 to 10 million, your funding options don't necessarily align with those requirements of much smaller micro entities, but you're also not into the realms of corporate finance yet. But there are still lots of opportunities out there for you to secure the right financing for your business. So the first thing that we'll have a look at is the different types of loans out there. So generally when you've got business loans, the first question is, do you want a secured loan or unsecured loan? And what we mean by this is there something secured to the loan? So an asset such as a property or some equipment that should you default on the loan, then the bank or the lender could take that asset in lieu of payment. So if you don't have anything secured against the loan and it's an unsecured loan, then that is of course more risky for the bank or the lender, and therefore you should expect to pay a slightly higher interest rate. And some businesses will be able to get unsecured loans and some businesses won't. That completely depends on your financial circumstances and your financial history. But really, if you have a solid business plan, then I wouldn't necessarily shy away from having a secured loan. There's no reason to go for one or the other. It does just come down to personal preference. So the other thing that of course you need to consider is what type of loan that you want and the length of period that's over. So as with when you get personal finance such as a mortgage, you can get fixed rates, you can get variable rates that track the Bank of England interest rate, for example. So you also need to consider whether you want certainty or whether, particularly now when interest rates are quite high and we're going to expect them to drop on the long term, whether it's best to go with a fixed or a tracker. And personally at the moment I would normally err on the side of caution, and I tend to take a fixed rate. However, at the moment I've been transferring some of my products over to a variable or a tracker because it's pretty common knowledge in the economics at the moment that the interest rate is only going to go down over the long term. So it really does depend on when you're taking that loan out and how cautious or risk averse you are. So where can you go to secure a loan? Because as I say, the vast majority of loans that are available out there are aimed at micro entities, and you'll typically see a lot of adverts online for loans of less than 25,000. And this is not really the realm that you guys are playing in. You're bigger businesses and you're likely to need 6 or even 7-figure loans. So therefore, what are the most appropriate institutions you can go to? Well, actually, they still largely remain the same. So the most common place that businesses go to get loans is the high street banks or the challenger banks. So the high street banks have very strict criteria when they're lending. So they will have a tick list of features that you must meet to get their loan. And it could be something silly like your postcode or your turnover must be under £1 million. And if you've done 1 million and 100,000, you're just simply not in their criteria and they'll decline you. So that is something to consider when you're going with the high street banks, is that their lending criteria can be quite strict, and it is a case sometimes of a computer making a decision, and it's not necessarily based on the business plan or the viability of your ability to repay that loan. So that can be quite frustrating when you're dealing with the high street banks. But it's fair to say not all of them are the same, particularly if you can get an account manager and you can get a person looking at your application, then you do stand a much higher chance of getting your application approved on merit. There is an institution in the UK called the British Business Bank, and this is actually run by the government essentially. It's independent from the government, but it's government backed. And their sole purpose is to ensure that small businesses find it easier to get lending. So this is a really great place to start, and is probably always where I would recommend most small businesses go to. So there's two arms to the British Business Bank. The first is that they are a bank themselves and they do lend at commercial rates, but they also have lots of partners that work with them, which will be all of the high street and challenger banks. So the big names like HSBC, NatWest, for example, but also some of the smaller, more businessy names such as the Funding Circle and companies like that partner with the British Business Bank to offer loans under the various schemes that the British Business Bank run. So the British Business Bank, for example, they have specific loans for businesses looking to grow. They have specific loans for business recovery. They have specific loans for startups. So there is a huge variety. I think they've got nearly 200 partners at the moment. And you can apply on their website. It's super easy. If you do take a loan with the British Business Bank, that is different to if you go through the British Business Bank and get one of their partnership loans, but broadly the process will be the same. All of the rates will be commercially driven. The benefit with using the British Business Bank is that it's government backed and 70% of the loan is guaranteed by the government. So whilst you as the business is still fully responsible for the loan and repaying the loan, and should you have any issues repaying the loan, then the lender would go through all the normal processes to recover any funds that it could from you. But in an absolute last resort, the government will guarantee 70% of that loan to the lender. So the other place which is not very well known is the CDFI, and this is Community Development Finance Institution. And this is a not-for-profit organisation, and they lend funds to businesses. Now, this is kind of like a halfway house between like a charity and a bank, because actually 9 out of 10 of all of the loans that the CDFI grant are to businesses that have previously been declined a loan. So in particular, the CDFI will focus on businesses that are run in deprived areas or by people of ethnic minority backgrounds, so that type of thing. However, they completely set their own criteria as to who they want to lend to, and they will lend to absolutely anybody. So if you have been declined any type of lending from any of the other institutions, then they could be a really great place to access finance. The rates are still commercially competitive, they still offer loans over a long-term basis, and they can also give quite high six-figure value loans as well. So the CDFI is a really great option if you're struggling to get lending. So in order to get lending, you do need to complete a business plan. Now, as I said at the start, most business loans are given to businesses for cash flow purposes. So if you're loaning to a business for cash flow purposes, as the lender, you're looking to make sure that they can repay that loan out of the income that they've generated. So you'd be looking for a solid history of income into that business, and you'd be looking to make sure that there was just a cash flow hole rather than a long-term cash flow problem in their business. But when we're talking about growth, what you're essentially saying to the business is, what you're essentially saying to the lender is that lend to me on my idea. And this is where your business plan and the proposal that you put together for your application is going to be completely integral to whether or not you secure this loan. Because most business loans, as I mentioned, are less than 25k. So this will be a largely computer-based tick box exercise that banks will go through to lend. But when you're looking for a larger amount, so typically 6 figures, and you're looking for it probably over a 3 to 7 year period is the average when we're talking about growth lending, then what's in this business plan is going to be absolutely critical. And I will do some more videos on how to prepare a business plan for a bank or a lender. But really, you can't just have a written business plan. You have to have the financials in there that show that you have a business plan that you've got an A plan, you've got a B plan, so you've got a worst case scenario, you've got a best case scenario, and you've got an expected case scenario, because the bank will absolutely want to see that even in the worst case scenario, you can afford to repay that loan. So the business plan that you prepare has got to be much more comprehensive, much more detailed, and actually you tend to find that probably using a finance director like myself, for example, or somebody that is more experienced in doing a business plan that requires that sort of detail is going to be what's required for your application here. So this topic here, credit scores, business credit scores, it's probably one of the things that's brandished about the most online, and is probably one of the most hocus pocus areas of business finance that there is. So as an individual, as a person, we all have a credit score. You can log on to any of the various credit sites and check it. And things like when you make mortgage repayments, or if you take out a loan, like even your mobile phone repayments, credit card repayments, that all gets automatically populated against your personal credit score. Now, there is this myth in the business world that happens with businesses too. But actually, whilst there is the technology available for that to happen, the reality is that doesn't happen very often. Because if you think about the businesses that you're doing your most transactions with, they are not these big institutions that are linked to the business credit institutions like Dun & Bradstreet and CreditSafe. So the big institutions in the UK, I've just mentioned Dun & Bradstreet and CreditSafe are two of the biggest in the UK. And they do calculate a credit score for a business. But the number one source of information that they're using is your accounts that you publish on Companies House. Now, they pull this information, they analyse this information, but we know from looking at our annual accounts that your accountant prepares for you that there's very limited information in there. They've got no idea how often you pay your creditors, they've got no idea who your creditors are, they've got no idea whether you're late payers, on-time payers. So you can see how the information that goes into your business credit score is incredibly limited. Now, as I say, there is the possibility for you to optionally provide additional information. So you can go onto some of these websites like CreditSafe and submit information about your customers and your suppliers and tell them how frequently you're paying, how frequently you're being paid. But the reality is that most businesses are not doing that. So the information available for business credit scores is incredibly limited, and it will come into a decision made by a bank or a lender because they will run a credit score for your business. But unless anybody has submitted any information about your payment history, and as long as you don't have any CCJs or historical legal claims against your business, then it's likely to be entirely based on what's on Companies House. And that is where you can use that piece of information to work in your favour. So, for example, the timing that you publish your accounts on Companies House. So if you've had a really, really strong year, then you want to get your accounts onto Companies House ASAP, especially if you're thinking about making a finance application, because then that's available to your lender. But ultimately, you just need to be prepared to release your full accounts to the lender, because if you are open and transparent about your finances and you're willing to share your monthly management accounts with the lender, then they're much more likely to lend on that rather than the very limited information that's available on Companies House. So moving on to the tax benefits of having a business loan versus a different type of finance. Now, when you are making your monthly payments, as with a mortgage, there's going to be an element where you're repaying the loan and you're paying interest. So any interest that you pay is tax deductible. And so if you're in the top band of corporation tax in the UK, that means that essentially you're going to be paying 25% corporation tax saving on the interest that you pay. Now, if you were to take out a business loan at the moment, typical rates are about 9 to 11%. So on a £100,000 business loan over 5 years, you're going to pay about £30,000 of interest at the moment. So you'd immediately save 25% of that in tax. So that does make it more beneficial than when we're looking at some of the other options, such as equity loans, where there is no benefit whatsoever from a tax perspective. However, with a government change likely coming up with the election in 2024, I would say that as a business, you need to be very careful about making long-term decisions in your business based off tax policy that literally could change any day. The current Tory government could announce a change any day, but also Labour are likely to try and bring in some of their own policies should they come into government too. So nothing's ever guaranteed with tax policy, and if you're making a decision and you've got option A and option B and they're identical except for the tax, then by all means go with the tax. But otherwise, this pretty much is not guaranteed, and it shouldn't be a main criteria when you're considering what the right lending is for your business.